Hey everyone, welcome back to Corporate Decoder, the place where we try to uncover the real story behind those DenSec filings. Today, we're diving into MAIA Biotechnology, Incorporated's latest quarterly update. And let me tell you, there's a lot going on under the hood, including a big pivot that might surprise you. Before we jump into the numbers, if you love getting the inside scoop on what really makes companies tick, make sure you are subscribed. We break down these complex reports so you don't have to. Also, join our growing community on Discord, linked in the description below, for more discussions and direct access. So, Massachusetts MAIA Biotechnology is back with its quarterly report, and this one covers the period ending the 30th of September 2025. They are a biopharmaceutical company focused on developing cancer drugs. But as we'll see, they are also venturing into some very new territory. Let's start with their balance sheet. On the asset side, they have about $10.9 million in cash as of the 30th of September 2025. That is up from about $9.6 million at the end of 2024. That increase in cash is good to see, especially for a company deep in research and development. Now, when we look at liabilities, accounts payable and accrued expenses have jumped significantly. Accounts payable went from $1.5 million to over $3.1 million, and accrued expenses shot up from $2.3 million to a whopping $6.8 million. That is a big increase in money owed to others, which can put a strain on cash flow. The warrant liability also decreased, which is generally a positive sign as it means fewer potential future obligations. Moving on to the income statement, this is where we see the core of their business activity for the 3 months ending the 30th of September 2025. Their net loss was about $8.9 million. That is a big jump from the $2.7 million loss in the same period last year for the 9 months ending the 30th of September 2025. The net loss was around $18.8 million compared to a $19.7 million loss in the same period in 2024. So, while the 9-month loss is slightly down, the most recent quarter saw a significant increase in losses. This dramatic increase in losses this quarter is largely driven by higher operating expenses. Research and development costs jumped by about 138% in the latest quarter, and general and administrative expenses also increased by roughly 97%. This means they are spending a lot more money to develop their drugs. Now, let's look at what is happening with their shareholder equity. This table shows how the company's net worth has changed. It is pretty staggering to see that by the 30th of September 2025, their total stockholders' equity is only about $41,000. This is a drastic drop from around $3.6 million at the end of 2024. This massive decrease is largely due to the accumulated deficit, which is the total net loss the company has incurred since its inception. This deficit grew from about $87.2 million to over $106 million. This means the company has lost a lot of money over time, and that has eaten away at its equity. Let's look at the cash flow statement to understand where the money is coming from and going. For the 9 months ending the 30th of September 2025, net cash used in operating activities was about $11.8 million. This is very similar to the $11.8 million used in the same period in 2024. This shows the core operations are consistently burning cash. However, the inflow of cash from financing activities is crucial. In the first 9 months of 2025, they brought in over $13.1 million from financing, mainly through issuing common stock in private placements and their at-the-market offering. This is slightly lower than the $13.3 million raised in the same period in 2024. Basically, they are raising money through selling shares to keep the lights on and fund their research. Going concern, this is a big one for any company, especially one burning this much cash. The notes clearly state there is substantial doubt about the company's ability to continue as a going concern within 1 year. This means unless they can secure more funding, they might struggle to meet their obligations. They have a plan to control expenses, but the reality is they need more money. This section talks about how management makes educated guesses for things like stock options and warrants. It's important to remember that these are estimates, and the actual results could be different. They are issuing a good chunk of stock and options to employees and consultants. In the first 9 months of 2025, they recognized over $1.8 million in stock-based compensation expenses. That is a significant expense, and it dilutes the ownership of existing shareholders. This is a really complex area. The company has issued a lot of warrants which are like options to buy stock later. Many of these are treated as liabilities because their value can change and impact the company's financial results. They had to revalue these warrants multiple times, and these changes caused significant gains or losses in their income statement, making it harder to see the true operational performance. For example, On the 29th of September 2025, they amended warrants and recognized a cost of over $124,000. This highlights the complexity and potential volatility introduced by these financial instruments. They also detail warrants issued in various private placements and to their underwriters. The accounting for these, especially when they are reclassified from liabilities to equity, can be quite intricate and impacts reported earnings. It shows a lot of complex financial engineering happening alongside their drug development. They are actively granting stock options. In the 9 months ending the 30th of September 2025, they granted over 3 million new options. This is a common practice to attract and retain talent, but it also means more shares will be outstanding in the future, potentially diluting existing shareholders. The total unrecognized compensation for these unvested options is almost $4 million, which will be expensed over the next few years. This is where they lay out all the things that could go wrong. While their core business faces typical biotech risks like clinical trial failures, there is a new and significant risk factor they have added: investing in digital assets. This is truly the most surprising part of this filing. They have adopted a digital asset treasury plan, allowing them to allocate up to 90% of their treasury reserves to digital assets like Bitcoin and Ethereum. They're acknowledging this is a new and risky area with unclear regulations. They are worried about how these assets might be classified by regulators, potential security breaches, and the inherent volatility and liquidity issues of cryptocurrencies. This pivot is a bold move and introduces a whole new layer of risk. Looking at some of the recent financing activities, we see multiple private placement offerings. For example, on the 24th of February 2025, they raised approximately $2.7 million from selling shares and warrants. Then on the 3rd of March, they raised another $1.4 million. These deals are crucial for their survival, but they also come with dilution for existing shareholders. They've had an active at-the-market offering program with H.C. Wainwright & Company. In the quarter ending the 30th of September 2025, they sold over $2 million worth of stock this way. This is a way for them to raise capital continuously, but it definitely puts downward pressure on the stock price. And the at-the-market offering is continuing right through the end of the reporting period, and even after they've raised over $400,000 in just the first few weeks of October using this program alone. It is notable that during this quarter, none of their directors or officers adopted or modified any 10b5-1 trading plans. This is what they use to buy or sell stock without violating insider trading rules. And finally, the report is signed by Vlad Vitok, their Chief Executive Officer, and Jeffrey C. Himmelreich, Head of Finance. So what's the story here? MAIA Biotechnology is undeniably in a critical phase. On one hand, they are making progress with their lead drug candidate, adagrasib, and have secured important partnerships with big names like Regeneron and Roche. The fast-track designation from the FDA for adagrasib is a significant positive development. However, the financial picture is concerning. They are burning through cash at a high rate, and their equity has shrunk drastically. The increase in accrued expenses and the complexity of their warrant accounting add layers of risk. But the biggest story here is their bold, maybe even desperate, pivot towards digital assets. They are literally betting a large portion of their treasury reserves on cryptocurrencies. This is a massive gamble that could either provide a much needed lifeline or significantly exacerbate their already precarious financial situation. It's a high-risk, high-reward strategy that will be fascinating to watch. They are clearly trying to find innovative ways to survive and fund their drug development pipeline. What's your take on MAIA Biotechnology's strategy, especially their move into crypto? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a like and subscribe for more deep dives into company filings. And again, join our Discord community linked in the description for more in-depth analysis. Thanks for tuning in, and I'll see you in the next one.